Welcome to the continuation of accounts. We're going to discuss journal proper or the general journal. Okay, so what is the journal proper or the general journal? Okay, so far we've looked at the cash book, which is the book that is used for all cash and bank transactions. So whenever there is a transaction that has happened that involves cash and bank, then you're going to record that transaction in the cash book, right? We've also looked at the sales day book, which records all the sales a business has made that are on credit, okay? Then we've also looked at the purchases day book, which records all the purchases which are on credit. If you buy on credit, then the transaction has to be recorded in the purchases day book. Then in the last lesson, we also discussed the issue of returns, okay, where we emphasize that in as much as you can complete a business deal, you sell some products, maybe some of them may have issues, okay, maybe they can get broken during delivery, so the customer may return them. Or if you buy some raw materials, then maybe you don't like them or they are not according to the specification, you have to you have a right to return them, okay? So there's need for a diary, okay, or a journal or a day book where you record things that have been returned. And of course, that's where the returns inwards day book or the sales returns come in. So the sales returns is also called the returns inwards. Why? Because you sell, and when you sell, things go outside your business. So when they have been returned, they are returned into your business. Hence, returns inwards. Then also there's returns outwards, the book, which is for purchases that are returned. You buy something, then you take it back to the owner. So you have returned it outwards. Hence, returns outwards, the book. Okay, so what about this transaction? Okay, we've talked about the cash book, and also we talked about the petty cash book for small transactions, right? What about this transaction? What if you want to sell a vehicle for the business? Okay, a fixed asset. Okay, your business, you sell sweets. Okay, your business sells sweets. Okay, now you are deciding to sell the vehicle for the business. Okay, so that's not a normal sales, right? That's not a normal sales. Your business is not meant to sell vehicles, it's meant to sell sweets. Okay, so when you sell a vehicle on credit, where are you going to record that transaction? You cannot record it this in the same way as when you sell sweets on credit. Okay, another situation is this: you sold some sweets, then the person did not pay cash, so you sold on credit. Okay, so after some time, the person has failed to pay back. Okay, they have failed to give you your money. So in business, what you do, if someone has failed to give you your money, you record that as a bad debt, which simply means a debt that you cannot recover. Okay, so now that bad debt, where are you going to record it? Okay, so in short, there are some transactions that cannot be recorded in our 5 precious books. That is the cash book, the sales day book, the purchases day book, the sales returns, the purchases returns. Okay, so So what do we do with those type of transactions? That's what we're going to study today. Okay, so some of the main uses of the journals are listed below. The purchase and sale of fixed assets on credit. Okay, so now this journal proper, or the general journal, if you have a transaction where you purchase or you sell a fixed asset on credit, a fixed asset is not an asset that is meant to be sold, okay, or to be bought on a regular basis, okay, because a fixed asset is used in the operation of the business. Okay, so if you buy a premise, for example, that is a purchase of a fixed asset. You cannot record it in the purchases account. Okay, I mean in the purchases day book. Okay, it's not a transaction that happens on a day-to-day basis. Okay, so such transaction, such unique transaction, is going to be recorded in the journal proper or general journal. Okay. Also, bad dates, like I said, they are going to be recorded in the journal proper or general journal. Also, the correction of errors in the ledger accounts. So if an accountant has made mistakes, those mistakes must be corrected using the journal proper. Also, there are times when a business can be running without books of accounts. Then at some point it decides to start recording in the books of accounts. So it has started to keep the books of accounts. Okay, so in that case, the first entries are recorded using the journal proper. Okay, so the opening entries are recorded using the journal proper. So this is done once in that case. Okay. Also, the final type of transaction or situation that would need a journal proper is adjustments to any of the entries in the ledgers. Okay, if you want to adjust an entry, you have to use the journal proper or the general journal. Okay, so we're going to look about 4 of these, which is the purchase and sales of fixed assets on credit, writing off bad debts. 3 we're going to study it later. It's a topic on its own in grade 11. Okay, then opening entries, we're going to take a look at them, and adjustment to any of the entries in the ledger, we'll see depending on the time. Okay, so let's get started. Okay, so before we can look at each of the cases we mentioned, what is the layout of a general journal? What is the layout? Okay, so the layout of a general journal is it has the date, it has the name of the accounts to be debited and the amounts. It also has the name of the accounts to be credited and the amounts. Okay, so here I have to emphasize that in the other books I've looked at, the day books, the sales day book, the purchases day book, and the returns book, there was no debit and credit, right? When you're just doing the day books, there was no credit and debit. Okay, so in the journal proper, there's debit and credit. Okay, so the journal proper also contains a description and explanation of the transaction, okay, which is called the narrative. So in this narrative, you explain the transaction so that a person who's going through the journal proper can understand. And also, for you as an accountant, you need it to remind yourself of what that transaction was all about. Okay, so since there are these unique, strange transactions that we record in journal proper, hence a narration is very important. Then there's always a folio, which is a reference to the source document giving proof of the transaction. So a folio makes sure that the accountant cannot cheat, okay, because a folio will tell that the source document can be found at this and that point. Okay, But don't worry about this. This is just general information, especially for those who are planning to do accounting. So this is the layout of our journal proper, or general journal. So it has the date here, then the details, then the folio, debit, credit. So the details is going to have the name of the account to be credited or debited, and also the narrative, which is an explanation of what's happening for this given entry. So now let's learn how to enter transactions in the journal proper. Okay, so we're going to start with the first case, which is the sale or purchase of a fixed asset on credit. Okay, sale or purchase of a fixed asset on credit. Okay, so whenever you see there is a sale or purchase of a fixed asset on credit, remember the journal proper has to be used. Okay, so here's a question. A milling machine is bought on credit. A milling machine, it's a fixed asset. Okay, so a milling machine is bought on credit from Two Makers Limited for 10,550 on 1st July 20x8. Okay, so how do we record this? So this is simple. The company is going to there are going to be two accounts involved. That is the Two Makers account and the milling machine, right? So the Two Makers account will give away an asset which is worth 10,550. Well, the milling machine, the company, since it has bought a milling machine, so it has to create an account for this milling machine. So this account for the milling machine will receive 10,550, right? So in simple terms, we're going to have these transactions. So the milling machine or machinery account is going to receive 10,550 from the Two Makers, which is the value of the asset that the company has received, 10,550 in form of a milling machine. Then the Two Makers account, they are going to they have given away this machinery, the milling machine, which is worth 10,550. So this is the double entry, right? It has to be recorded in the journal proper. Okay, like so. Okay, so we're going to have date when this transaction happened, which is 1st July. The details we have. So here, pay attention to the details. So when stating the details, you start with the account that is going to be debited, the name of the account that's going to be debited, then the name of the account that's going to be credited. So in this case, machinery account was being debited, 10,550. Two Makers Limited was being credited, so it's 10,550. So start with debiting the machinery account, and then the Two Makers account. So always, when doing your details, start with the account being debited, go to the account that has to be credited, then narrate, explain. So what happened was we purchased a milling machine on credit, okay, which is a capital purchase, and there's some more details. Of course, if you're not given these details in the question, then there's no need to put this, but this has to be there: purchase of milling machine on credit. It's a narration. It's a narration. Okay, so it means you are done with your journal, the general journal or the journal proper. Okay, so this is the double entry for the two accounts that took part in this transaction. Then this is what we are learning today, the journal proper. So that example was the purchase of a fixed asset on credit. Now we look at the sale of a fixed asset on credit. Here is an example: sale of stationery no longer required for 300 on credit to Kellam on the 2nd of July. Okay, so we sold stationery. Okay, so we don't need this stationery. Our business is not in stationery. Okay, so this is a fixed asset that's been sold. Okay, so we have two accounts just like before. So the double entry for the two accounts has to be done. The two accounts are KLAMB and stationery. So stationery is going to give away, KLAMB is going to receive, right? So we're going to have this situation of stationery and KLAMB, right? KLAMB receiving, stationery giving, right? Then the journal is going to do the same just like before. We're going to have KLAMB receiving, stationery giving. Remember to always start with the account that is receiving. Then a narration here. Sales of stationery no longer required. Then you are done. Okay. We look at scenario number 2. Scenario number 1 was purchases and sales of fixed assets on credit. Scenario number 2 is centered on bad debt. Okay, bad debts. Okay, bad debts are debts that you cannot recover. You have just given up that, okay, there's no way I can get back my money, or the money that we were expecting from the sales we made on credit. Okay, so the question or the statement says a debt of 78 owing to us from H. Manda is written off as a bad debt on date 1. So this guy is supposed to give us 78, but they failed to give us. So we have to record it as a bad debt. Okay, so what we do is we going to have two accounts. So there's going to be the bad debts account, which is the account that receives all the bad debts. So the bad debts is going to receive from H. Manda 78. Okay, it's not receiving money, but since we have accepted that there's going to be a bad debt whose value is 78, so the bad debt has to increase in value by 78. Therefore, the bad debt has to be debited 78. Well, H. Manda, who had 78, who had the money 78, is going to give us back it spiritually, so to say. Yeah, in short, we're going to cancel out, forget about the money as if they gave us when they did not. Okay, but we're going to write that it's bad debt, which means we have accepted to lose this money. So in a way, H. Manda has given us the money. Okay, hope you understand what I'm trying to say. It's a debt. It's not the actual money that has been given. It's a bad debt. We have accepted that we will never receive this money. So we won't forget about that money. Okay. So H. Manda was supposed to give us 78, but he did not. Okay. So we record it as a bad debt so that our books of accounts know that we don't expect to get money from this person. So in a way, it's the bad debt has to increase by 78. Why is it increasing by 78? Because H. Manda has given us bad debt of 78. Okay. So in the journal proper, you just do just like before. You start with bad debt, debited, H. Manda, credited. Then you do a narration, date written off as a bad date. Okay, date written off as bad. Okay, then you are done. We go to scenario number 3, opening entries. Okay, so now scenario number 1 was simple, straightforward. Scenario number 2 was simple, straightforward. Scenario number 3 is simple and straightforward, but it's a bit longer. Yeah, like it involves more than one transaction, because this scenario, it's about someone who never trusted in accounts, so they never used to keep the books of accounts. Now they have seen the importance of books of accounts, so they want to start keeping the books of accounts. So what do? They maybe hire an accountant to start recording transactions for them. So they are called opening entries, the first entries. Okay, so here is what happened to Mr. Banda. Mr. Banda, after being in business for some years without keeping proper records, now decides to keep a double entry set of books. Okay, so on 1st July 2008, he establishes that his assets and liabilities are as follows. So assets, he has a van which is 3,700, fixtures 1,800, stock 4,200. Okay, then debtors, these are the assets. People who owe you money are assets, it's your money. Okay, so debtors, you have B Young 95, D Block 45, and bank 860. Okay, so these are our debtors. Then we also have cash, which is 65. Okay, then now we look at liabilities, the people we owe money. Okay, so we have people, creditors, M Queen at 129, C Waters at 410. Okay, so of M Queen and C Waters, okay, at 410. Okay, now if we calculate the total assets, we are going to see that the total assets, adding all these assets here, will give us total assets 3, this will give us 10,765, and liabilities will give us 539. So from this you can calculate the capital. Okay, you remember the accounting equation. Okay, so you can calculate the capital from here, but even just using the journal proper, you can calculate the capital. It can help you with dealing with this summation. Let me say that again. So this the journal proper can help you to calculate the capital as well. Okay, but the capital, according to the accounting equation, capital is assets minus liabilities, so don't forget this. Okay, so in this case, capital is going to be this minus this, which is going to be 10,226. Okay, so here's the situation. Why are we talking about capital? Maybe I did not introduce that part properly. So this Mr. Banda has assets, and also he owes people money. So when starting a business, we have to know the capital. When starting a business, we have to know the capital. But when you started the business some time ago, you had some capital, right? But now, since you are not recording books of accounts and you want to start recording books of accounts, so the books of accounts need a capital, because according to them, that's when you're starting a business. So it's very important to know how to calculate capital by comparing the amount of assets to the amount of liabilities. So we have seen the transaction. What are the steps? What is it that is required of you to do? The first is to record each item in the journal proper. So each item has to be recorded in the journal proper. The second step, once you're done recording the items in the journal proper, which is the objective of this lesson, is to open assets accounts, one for each asset. Okay, so here it's not about the journal proper. Here it's about, doing opening entries for someone who's not keeping books of accounts. So you open assets account, one for each asset. Okay, each opening asset is shown as a debit balance. So each asset is going to be shown as a debit balance. The third step is to open liability accounts, one for each liability. Each open liability is shown as a credit balance. Okay, then you also have to open an account for the capital. Okay, you have to show it as a credit balance. Okay, how do you open an account for the capital? You need to calculate the capital. Then the capital you're going to get, you're going to put it on the credit side of the capital account. Okay, okay, so these are the details. So we have to come up with a journal proper, and our journal proper is this. So let me take you through each part of the table. Okay, so of course the date is going to be this side, the details are here, and remember how you write the transactions. You start with the debit, the ones that are going to be debited, then you go to the ones that are going to be credited. Okay, so with, of course, assets are always going to be debited, debtors are going to be debited. I mean all types of assets, from fixed assets, debtors, bank, cash, they are going to be debited. So vans, fixtures, stock, all debited. Debtors, which are two, B Young and D Block, all debited. Bank, cash, and creditors, they are all, bank and cash, they are all going to the debit side. Okay, so all these have gone to the debit side. All the assets, all the debtors, bank and cash. The liabilities, on the other hand, go to the credit side. So of M Queen is 129 and 410 here. So M Queen and C Waters. So we record here, right? Then now we need one more, capital. Okay, remember we calculated capital, but even without calculating capital, you can get capital from here. All you have to do is to add all these figures minus these two figures here. Okay, that is all the items on the debit side minus all the items on the credit side. The difference is the capital. Okay, so you're going to have your capital there and you write a difference here. Okay, or if you want, you can just add all the assets minus the liability. What you get is the capital, and you also put it on the credit side. Then you get a total and the total of this side. It means your journal proper is done. Now we got the objective of today is done. Now we go to finishing now other records. Okay, step 2. Okay, right? So this is our journal proper, right? So now the next step, of course, we're going to record these transactions. Okay, so don't get confused. We have the journal proper here, then we've got another table here called the general ledger. So we're going to start with now opening the accounts for all the assets, which is step 2. Okay, so the first 3 assets we have van, fixtures and stock, right? So the van we write on the debit side, so the details will be balanced. Okay, fixtures debit side details, all of them, they're going to be balanced. Stock, okay, we're going to have stock here. Then also capital, should be recorded in the general ledger. Capital should be recorded in the general ledger. So capital that we calculated, that was on the credit side, so we're going also to open the account for the capital, but of course we'll put on the credit side, not on the debit side. Okay, we continue with other assets. So we have these debtors, so Biang, so we have Biang account. Now note that this is not the general ledger. Okay, so the first 3, the fixed assets, those ones are supposed to be recorded in the general ledger. Okay, including the capital. Okay, now these ones, the debtors are people we sold items on credit. Okay, so these ones are supposed to be recorded in the sales ledger. So in the sales ledger we have Biang. Okay, still they are assets, so they have to be debited, and Diblek also asset has to be debited. Okay, next we look at the creditors. Okay, so the creditors, of course I've skipped this, we'll come back. The creditors, we have M Queen. Now creditors are people we bought things on credit, so we purchased things on credit, so they're supposed to be recorded in the purchases ledger. So of M Queen, we're going to credit 129. C Waters, we're going to credit 410. There should be C Waters here. It's just that there's not enough space for me to include C Waters here, but that's how to do it. So now we started with the general ledger. We recorded all the fixed assets, right? Then we moved to sales ledger. We recorded all the debtors. Then the purchases ledger, we recorded all the creditors. Now we'll go to the cash book to record these 2. Okay, so the cash book is going to have, 2-column cash book. The cash side is going to have a debit of 65, and the bank side is going to have a debit of 860. Okay, so that's how to do it. Let's look at scenario number 3. So in scenario number 3 is just a recap. We've looked at scenario number 1, purchases and sales on credit or fixed asset. Scenario number 2, bad debts, right? Scenario number 3 was opening entries. So this is scenario number 4 actually, which is adjustments to any of the entries in the ledger. So when there's a change to an entry in the ledger, we use the journal proper. Okay, so here is an example. K Young, a debtor, owed 2,000 on 1st July 20X9. He was unable to pay his account in cash but offers a 5-year-old car in full settlement of the debt. The offer is accepted on 5 July 20X9. So this Young was unable to give us the money. Okay, so there is an existing transaction which says that we sold Young something on credit. Okay, meaning that Young has not paid. Okay, so this Young has decided to give us a motor vehicle, right? So this motor vehicle we're getting, since we have gotten it, it has to cancel with one of the entries. In short, our books of accounts have to show that Young paid, and also our books of accounts have to show that we now have a vehicle. Okay, so this can be handled by the journal proper. Okay, so what is happening here? We're just adjusting an existing transaction in our books of accounts. So in this scenario, we have K Young. So this K Young, if we open our books of accounts, we're going to discover that he had this 2,000. He received our goods that were worth 2,000, right? But he has given back. He has given us back a motor vehicle which is worth 2,000. So we can add motor vehicle 2,000. Don't be confused on how the entries are made. This is just for simplicity. If you are used to that way of the format where you write the details here, you can write the date here and motor car here. Okay, then you just on the credit side you just show the amount. Okay, I hope you get what I'm saying, but this is just for illustration. Okay, then the motor car account is going to have K Young receiving 2,000, meaning that, let me say that again, the motor car account is going to receive 2,000 because the company has received a motor vehicle worth 2,000 from this guy K Young. So the motor car account 2,000 from K Young. Okay, now this is not a journal proper, so this has to be recorded in the journal proper. The journal proper is easy. From now, I'm sure you can tell how the record are going to appear. We're going to have two accounts. We'll start with the debit, then the credit, or let me say that again. We're going to start with the account that's going to be debited, then the account that's going to be credited, then a narration. It's done. Okay, so car is receiving, so 2,000. K Young is giving 2,000. Explanation: accepted car in full settlement of debt. Okay, you are done. So the final scenario, which we're not going to discuss here, but later, is called correction of errors. So if there are errors in our books of accounts, they can be corrected using the journal proper. Okay, but we're not going to look at that now. We're going to start this later. So see you in the next lesson.